Good morning, Mark. We are good to go.
Thank you, Juan. Good morning, and thank you for joining this webinar presented by IACA, the International Association of Consulting Actuaries. Management of business risks is a key element of success for any actuarial practice and for any business. Professional indemnity insurance can be an important part of this risk management. A panel of experts from the US and UK have joined us and will discuss how to do your best to avoid claims and issues relating to professional indemnity insurance. Our speakers include Rich Brew. Rich is with Hub in the US. Rich entered the insurance business as an agent in 1978. He subsequently joined Green Hazel in the 1990s, which later became part of Hub International. He's focused on servicing property and casualty needs of business throughout the South. And Rich has been involved in securing professional indemnity insurance for members of one of the larger actuarial groups in the United States. Next speaker will be Neil Williams with Alexander Howden. He's an associate director dealing with claims in the professional indemnity division. He's got a law degree and is otherwise qualified in the business. He has 18 years experience in dealing with a wide variety of professions, including actuaries, accountants, solicitors, surveyors, and architects. Finally, our last speaker is Rachel Healy, a partner in the law firm of Reynolds Porter Chamberlain. Rachel specializes in professional indemnity and financial services dispute resolution. Rachel has defended actuaries in legal proceedings and before the Institute and Faculty of Actuaries. She also represents actuaries in dealing with the pensions regulator. She regularly advises actuarial firms on risk management and regulatory issues. So our first speaker is going to be Rich. Rich, please take it away.
Thank you, Mark. Good morning, everybody. I'm going to start with kind of an overview of basically just risk and for small business, and then lead into the professional issues, and then defer to Neil and Rachel, who will give you some real specific information on the claims and danger side. But basically, where we see it in the U.S., the need for insurance policies is typically from clients who are requiring you to sign a contract, and that or you're bidding on a piece of business that has a contract requiring these things. And there's something you need to know about these contracts. A lot of them will have limits requiring you to have certain limits of liability. Some of them will be very high. And they'll also have other policies that they're requiring in this contract. The other thing about these contracts is that a lot of them are written by some procurement departments or folks that took some contract language out of some construction contracts that they're familiar with and tried to make it apply to a professional consultant, which they don't go together. And that's what I see a lot of. Is I'll get copies of the contract from an actuary that needs to comply with these requirements, and they're asking everybody in the world to be named an additional insured, and they'll want these absurdly high limits and all sorts of language in there that basically tries to transfer their risk and their responsibilities to their consultants, which is what they're used to doing with construction contractors. That's how you would do it, is you would transfer all the liabilities while they're in the mode of building something to the construction company, so that the owner of the project isn't responsible for what goes wrong while they're building something. Well, this doesn't transfer well into the professional arena. And the issue with the named insured on policies, they basically want you to to take over the responsibilities for whatever it is, if it's their pension plan or what other project you're doing for them. And then if something goes wrong, they want you to take care of them, i.e. they want your insurance company to take care of them. And that's kind of the mindset they start off on in a lot of cases. And so this is what you need to basically prepare yourself for, as a way to manage your clients so that they understand what the job is that you're doing for them, and try and get them to understand that you're not responsible for a lot of the issues that they may want you to be responsible for. Their own data, for instance, whether it's accurate or not is their responsibility. And this needs to be really driven home by you when you're dealing with them, is get them to get up to speed as to why it's important that they still provide accurate information, still do their jobs. As you're a consultant giving advice, they're the ones that are ultimately making any decisions. And a lot of times they tend to want to brush the decisions off to their professional consultants. And this is something that you're going to want to just basically educate them on. So on the next slide, we get into basically your policies. This is what's typically required by your clients, whether you have a contract or not. This is kind of the assumption that you'll have. The general liability, and I thought I would just start at the beginning. A lot of you may already know this. Sorry if that's the case, but just to give you some groundwork and why the professional liability is different. But the general liability covers bodily injury and property damage for anything you may do with regards to damaging other people physically or their property. Now, as a consultant, you have little to no risk for this. It's very, very low. However, it may show up in the contract that you're required to have $1 million, $2 million, or $5 million umbrella, which an umbrella policy basically is higher limits that would go over your general liability, bringing up the limits. This this is where the language for naming additional insureds all centers around in terms of contract language. Most of the general liability policies do allow to name your clients as additional insureds, and any bodily injury or property damage you cover will also respond and protect your clients. Again, since you have very little to no risk of injuring someone or their property in the scope of work that you do, this is a lot of window dressing and much ado about nothing. However, in the US, this pricing is pretty low. It's easy to get. They're not a big deal. And it will, many times in there, the requirement will also be for auto insurance to be included. And on your general liability, if you don't own any vehicles in your corporate name, you're basically driving your own vehicle. It's easy to add non-owned auto to the general liability policy, which will also cover your company and take care of that part of any contract requirement. The next area is cyber liability, and this is for loss of client data, et cetera. The issues here with this cyber, this is kind of a growing field, especially here in the US. And it's grown not due to real risk per se, but to regulation and regulatory bodies and states and various federal laws requiring you to protect yourself for losing client data. Now, the way this has evolved is basically you've got governments, whether it be state or federal, that are essentially saying if you get broken into by a criminal, like your house is broken into, we're going to require you to have a bigger lock and a stronger door. And if you don't put that door and lock on for this criminal that's going to come attack you, then we're going to fine you if you don't. And that's kind of where the cyber liability insurance policies have taken off, is really more to protect from the bureaucrats that are going to come and try and fine you should you lose client data. Now, one of the best ways to mitigate this is to try and have your data screened before you get it, so that it doesn't have social security numbers and stuff from the client to where you even have a risk of losing any sensitive data and so forth. But basically, that's kind of how that evolved. Again, this is not a very expensive policy. Typically, it's not like your professional liability. And the reason for that is once it's gotten into the courts, it was realized that there wasn't real damage that could be shown to the judges and the juries on a cyber liability situation where data has been lost. And this is what frustrated the bureaucrats to begin with, to cause them to put in fines and penalties if you don't protect client data. So these things are more of a populist type policy that gets thrown into the language, and it's there. And then I'll get to next to the professional liability. And why is the cyber not included in the professional liability? Because if it's a mistake where you've made an error and let data get released, why isn't that covered by the professional liability? Well, it used to be. It was something that was covered because it didn't happen often, and it wasn't as big an issue back in the day before we had everything on computers. And so the professional liabilities did respond. And however, now that it's become more of an action having to do with bureaucrats, there's a tendency to want to separate that out from your professional liability errors. You certainly don't want a large cyber loss on your professional liability impacting what others might perceive as a mistake or error you made in professional work when you were basically attacked by some third party, essentially a criminal, and causing you to lose money through your professional liability policy. And when we get these loss runs on what your past history has been, and you see large claims being paid out having nothing to do with your errors and your professional work, that gets very messy. So the solution has been for a lot of the professional carriers in the States anyway, to provide a small limit of coverage for any cyber losses, like 25,000 or 100,000 sublimit under your professional liability policy. And this is another way to highlight that basically they're not providing coverage for this cyber loss. And this is how they're going to go about doing it, is by providing a small sublimit to make it clear that they don't intend to really cover that area. And nor do I think they should. I don't think this is good for you to have that kind of polluting the professional work that you're doing. So now the professional liability policy is designed to protect clients for financial loss you cause them. So whereas your general liability covers bodily injury and property damage, your professional liability is basically money. It is covering loss of money that you cause to your client. Now, the issue here with regards to this is that your client will think, well, anytime I lose money, the professional liability of my consultant will take care of it. And that's not the case. And this is where a lot of claims get involved with clients who misunderstand the purpose of professional liability and end up suing you just because they don't like the results or the fact that they don't have as much money as they want and that sort of thing. The professional liability policy covers for errors that you make as a professional. If you have not made an error, then the professional liability may or may not respond adequately in that you didn't make an error. So a lot of it has to do with how the attorneys structure the lawsuit if they were to come after you. And this is a big issue with regards to whether it's going to respond in your situation or not. So again, educating the client into how the professional liability works, it has to do with an error you've made, not the fact that they don't like the answer you gave them, or they don't like the fact that they don't have a lot of money anymore, or whatever it is. And so this is a big area that the client needs educating on, is that basically these mistakes are something that is has to be contemplated with your agreement with them. So this is something that as I say, leads to a lot of misunderstanding and a lot of anger, if you will, on the client's part. But it's part of your client management. And one of the things that you'll see as we move forward with the other two speakers is that trying to manage the client's expectations and how you communicate with them and how you're going to deal with mistakes and errors is all part of your job with regards to managing the client. the way to basically, or at least what we see trending in the US, is a lot of actuaries will have language in their contract with their client that says we're only going to be responsible for any mistakes or errors up to the amount of our fees. That's a big popular thing. It's not really effective in terms of actually doing anything with regards to claims. As far as if you get in front of a judge and jury, that's going to end up being fairly meaningless. However, what it does do is alert the client to the realities that your liability exposure should be somewhat comparable to and aligned with what you're charging them. In other words, if you have a client that wants you to have $10 million in liability and you have a job with them for $10,000 or $15,000 in revenue, there's no correlation there between the revenue and the amount of exposure they want you to take on. So this is where if you start doing these languages to get into educating your client with regards to how much exposure you should have with regards to mistakes, it should be something comparable to what your fees are. And this is what a lot of actuaries are starting to do, is to try and negotiate that, yes, there's going to be mistakes and errors, both from the client data side and from possibly the professional side in one of the calculations or something. If that happens, what do you do? What are the steps? So, so this is where you want to start headed with regards to steps taking to mitigate your exposure. Okay, Juan, that last slide there. So in your engagement letters and your contracts, if you're signing a contract with a client, one of the things that'll tend to happen is they're going to add on more work with regards to the original contract. They're going to say, we want you to do this other project or add into this. And a lot of times that does not get added to the contract or amended or clearly spelled out. And so every time you do any work for a client, you're going to want to have some sort of contract or engagement letter describing the work and clearly spelling out what you plan to do for them or not do for them. All your work that you're writing and sending in on reports, the caveats. This is really more a matter of someone else seeing the work, not your client. We've seen a lot of activity with regards to third parties getting the work and then bring in actions because they don't like the answers. Again, your work is for your client, not for third parties. Your client is paying you. Your client is the one that you do the work for. And third parties are the ones that tend to want to get in here. And that's what your client wants you to protect them from, is these third parties. And what the client needs to understand is, no, you're protecting your client. And so the professional liability, I forgot to get into the named insured issue. They'll want you to name them as additional insured on the professional liability. This is something that can't be done for the professional side. And the reason is the professional policy, the professional liability is protect your client. If they're named insured, that makes them a partner on the policy. That means that they can no longer come after you for that policy's limits, and that they're one of the insureds on the policy. So that's why they don't need to be, nor should they be, an additional insured on the policy, is because the policy is there to protect them, not the third parties. Is to protect them for mistakes you make that would injure them. And then the last thing I just want to touch on was peer reviewing your work. This is a very popular thing in the States, and this is basically developing a network of other firms similar to yourself or ones that specialize in a little different area for parts of a contract that you may not be as familiar with. And the very reason that these associations are so good, the one that you belong to here, would be one that you would want to try and develop your network with, is other firms to help review your work and have a second opinion. And at the same time, this is something where you could work it in with your client, where the more review that's done, the more fees that could be potentially asked for and warranted. So basically, I'll leave it at there. That was kind of the overview of basically why and the wheres of the different policies and why the professional liability starts to become a bit of an important snag.
Okay, Neil,
Excellent.
over to you.
Yeah, thanks, Rich and Mark. Yeah, Neil Williams from Howden here. I'm going to be talking from a UK perspective, and I just wanted to start by just talking briefly about the insurance market in the UK. It's a very difficult place at the moment, the insurance market. A couple of years ago, Lloyd's of London, which is obviously our biggest insurance market, carried a thematic review of professional indemnity insurance and discovered it was the second worst performing class. So basically they were making lots of losses. And that led to a contraction in the market. There were strict controls over how much underwriters could write, how much business they could place. And so that led to contraction in the market and less insurers being involved. Since then, obviously, we've had the dreaded B word, Brexit, which has caused more uncertainty. I think Boris is on his way to Brussels now to try and sort that out, but it's certainly caused a lot of uncertainty in UK markets. And obviously now we've got the COVID situation. So there has been a significant contraction and concern within the insurance market, and professional indemnity is one of those areas that's caused a lot of concern, which has meant that premiums have gone up very significantly over the last year or so. So it's more difficult to buy insurance and it's more expensive to buy it. And also insurers are imposing stricter policy terms and taking more policy points if you don't adhere to policy terms and conditions. It's also worth noting that if any of you happen to buy excess layer insurance, so if you've got a limit of £1 million and then you buy another layer of insurance, the excess layers of insurance have gone up very significantly as well. Just specifically on actuaries, there are very few insurers in the UK that will underwrite actuaries anyway, so it's an even particularly more difficult space to work in. It's partly because lots of insurers' reinsurance programs won't allow them to underwrite actuaries. I think this, one of the key areas of concern is that if there is a claim, that insurers would be concerned that there was perhaps a systemic problem with the work that was undertaken, i.e. that the error that had been made had been replicated numerous times, leading to large and significant claims. Anyway, I just wanted to sort of flag that, the situation in terms of the market, in the sense that it's so important to concentrate on risk management and make sure that you're on top of all the risks in relation to your business. If we just have the next slide. Great, thanks. I always put this next slide in my presentation, again, just as a little reminder of why it's important to think about risk management. If you do have claims, and they do happen occasionally, I mean, that's what your insurance policy is there for. It's important to bear in mind, they're very time consuming and stressful to deal with. The whole process of dealing with a claim could take many, many days. I mean, the example I've given there, I said 10 to 14 days to deal with a claim. I think you'd probably be lucky if you got away with that. I'm sure Rachel, who speaks next, would agree with that. So it's just important to bear in mind that, the impact it can have on your business if you do have a claim. So it's worth thinking about your risk management processes. Just moving on to the next slide, if we can. For me, there are three key areas to think about in terms of risk management. It's not complicated. Most of this is not rocket science. It's about following basic practices. The first part is the paper trail. This is such an important part of any risk management process. Your engagement letters, how you contract with your client, setting out what you're going to do, what you're not going to do, and who you're doing it for. One of the things for actuaries is you've got to be clear as to who your clients are. You might potentially have a number of different clients. You might have trustees involved. You might have an employer involved. You may also even do work for an employee. So you've potentially got a number of different parties that you're working for, and you need to be clear about who you're doing that work for. You also need to be clear about which bits of the work you're doing. I imagine that quite often you'll be working with lawyers and investment advisors, and there'll be times when you're all sort of, exchanging emails, crossing paths on different issues. But it's important to be clear about which part of it you are responsible for, because if there is an issue that arises, you want the lawyer's E&O policy to respond to their part of it. And if there's an investment advisor involved, you want them to be responsible for any errors that they make. Again, just following on from that, it's really important to keep the paper trail going in terms of, what you're doing, in terms of process and how the work you're doing for the client. So they're up to speed with what you're actually doing. Again, things like telephone notes and meeting notes. I had a case last year, actually involved an accountant rather than an actuary, but they'd had a meeting with a client, and they hadn't taken an attendance note of that meeting. There was then a dispute as to what advice was given in that meeting. And certainly in the UK, if there's a dispute like that and there's no contemporaneous documentation, the client's version of events will always be believed. So in that case, the partner of this accountancy practice had a claim against them that settled for about £500,000. And it had also taken up a huge amount of their time. So that 10-minute attendance note versus the significant claim, it's worth bearing that in mind, next time you have a meeting with a client. Because I think we're all in the same position at the moment. We're all working really hard, and sometimes it's easy to let the paper trail slip by a little bit. Thanks. We just have the next slide. The next sort of key area of risk management is the client, and Rich has already dealt with this very effectively, but it's just really important to think about who your client is, know your client, who they are. I've said there on the slide, don't get too close, but it's important to have a good working relationship with your client, obviously, and it helps manage all sorts of different processes, but always be aware that, if something goes wrong, your client might potentially sue you over that issue. And again, that comes back to the point about the paper trail. Even if you've got a good relationship with somebody, if the work has gone wrong, or if there's a substantial difficulty with the work, there is a good chance your client will still sue you if that happens. So, knowing your relationship with your client, if the client has had previous advices where the relationship's fallen apart, why is that? Ask that question. Again, in relation to the client, if they're not paying your fees, why are they not paying your fees? Quite often, certainly in the UK, we see claims arise when a client can't afford to pay your fees, and they devise spurious grounds for bringing a claim to avoid paying your fees. So keeping on top of the work that you're being paid for is really important. Keeping an eye on whether clients are actually paying your fees is a key indicator of whether there might be the potential for claims. If we just move on to the next slide, that'd be great. Thank you. Your people. Obviously, this is the third strand in terms of risk management that I just wanted to touch on. So this is a key part, again, making sure that all the people you're working with have appropriate skills and are keeping up to date. Supervision. I mean, at the moment, it's so difficult, isn't it, to keep on top of supervising people and working collaboratively with people. Again, just from my own experience, I've just employed somebody recently, and I'd not met them before, and trying to build that relationship over Zoom or Microsoft Teams or whatever you use, it's a very difficult thing, isn't it? And I just think it's particularly important to keep that process going of good relationships and good communications within your business, and to have a culture where you do have good communication, where if things do go wrong, you do talk about it. Again, in terms of communication, it's thinking about the ways that you communicate with each other and with your clients. Increasingly in the modern world, we all use all different forms of communicating with colleagues and with clients. I've had several clients recently that have got into difficulty by sending text messages and WhatsApp messages. If you are communicating with your clients using those media, then think carefully about how you're recording that. Your WhatsApp message to your client can be relied on in court just as an email can be. So it's worth bearing that in mind. And also the context in which you give that advice. If you're using WhatsApp or whatever it is, quite often your messaging is more relaxed, but you're still giving formal advice. So it's just worth bearing that in mind as well. If we just move on finally to the last slide. This is about making claims or notifying claims under your policy. Certainly within the UK, you're obliged to notify circumstances which might give rise to a claim. So if a client's grumbling about something or concerned about something, or if you're aware of a potential error that might have been made, then you should have a conversation with your broker. Obviously, if a claim is made against you, you should notify that straight away. But my strong advice to you would be, if you're concerned about any issues with a client, is to pick up the phone to your broker. That's what they're there for, to support you through that process. People do have claims. That's what the policy is there for. And depending on the size of your business, your insurer will almost expect you to have notifications. They'll almost be surprised if you don't, in the sense that they'll be wondering, if you're just not notifying anything. And just going back to the culture point I made earlier, it's really important that you as a business make sure that staff within the business are happy to come forward if they've found a problem. Again, in the current environment, it's quite easy, I think, for somebody to sit in their home worrying about a piece of work they've done when they should perhaps be talking about it. Because failure to actually notify something can cause potential problems with your professional indemnity policy and create a more difficult situation as well. You know, usually your policy will give you access to professional advice. Rachel, who's speaking next, for example, you know, deals with a lot of litigation. She might have good advice to give you in terms of how to deal with it. You may also find that your policy is more helpful than you thought. Some of the policies that we place provide things like mitigation cover. So it will provide you with some cover to protect you, so the insurers would pay out to avoid a claim. Some policies also provide public relations cover. So they'll provide a small limit of, say, £20,000 where money can be spent on public relations experts if there's an issue in the public domain, concerns about you as a business. So your policy has all sorts of things that can help you. So that's another reason why it's really important to notify issues that do come up and certainly have a conversation with your broker about it. And likewise, I mentioned at the start about systemic failings. If you do notify something, make sure you have a conversation with your broker about whether that issue might have been replicated with the same client or other clients, because it's important that those issues are all notified together at the same time. I think that probably pretty much covers out everything I wanted to talk about that. My only other key message would be that, particularly, you know, in the UK, and I'm sure it's the same in the US to some extent, is when it comes to renewal, you get your renewal forms come through from your broker. Don't leave it to the last minute. Get involved in the process months before. Start thinking about what information you're going to provide to your broker to demonstrate that you're a good risk and that you're keeping on top of risk management. And likewise, if you've had claims or notifications, put some narrative around that, explain what's gone wrong, if something has gone wrong, and what you've done to make sure that that doesn't happen again, because an underwriter will look at all of that information and from that information decide whether you're a good risk and whether they want to underwrite it and how much premium they're going to charge you as well, which, you know, these days can be a very significant cost to your business. On that note, I will hand over to Rachel for the last part of the talk. Thank you.
Thank you, Neil and Rich, who've obviously done a brilliant job there at setting the scene for my section, which is to talk from the legal perspective when it comes to what I call practice protection, but other people may call risk management. And as I see it, that falls into sort of two different categories. First of all, the holy grail of trying to avoid claims and complaints being made against you altogether. And secondly, to do something that Neil's spoken about, sort of minimising the effects of claims. So if they are made, hopefully being in a situation where you can deal with them quickly, effectively, without trying to take up too much of everybody's time. And as Neil's already mentioned, that can be quite substantive depending upon the types of issues we're dealing with. So just going to the next slide, you'll see in relation to this some ways of avoiding claims, and Rich and Neil have already rightly talked about a few of these points. First of all, scope of engagement, which I'll come to in a minute. But what I want to touch upon a little bit for this section is the recording of advice and instructions and keeping the file up to date. Neil made some really key points there around the importance of having contemporaneous notes on your file. It's fair to say that English courts and the US courts rely heavily upon contemporaneous documentation. They expect advisors and professionals to make a note of the instructions that they're provided with and the advice that they provide. And if they don't have a note or some sort of contemporaneous record, then they're more likely to hold that against the professional than against the client, customer who's making a complaint or claim. Now, there's lots of ways you can do that, and as a lawyer, I see lots of files and I see lots of people's papers after the event. And that can be anything from making a note of your time records to emailing yourself to emailing the client. I would always suggest that the best option to record advice and instructions is to email the client after a telephone call. It doesn't have to be long. It just has to be, we've spoken about this and we've agreed X, Y, and Z, because not only is that a contemporaneous note, but from a legal point of view, it also gives the client the opportunity to come back and say, well, actually, no, we didn't agree that. We agreed X, Y, and Z. So it becomes not only that note which you've made during the call, but it becomes something that's very hard then for the client to dispute in terms of the advice that was given or the instructions that they provided. And just going back to what Neil said, if a complaint or claim is made, if I get a file, the file that's subject to the complaint or claim. If I've got that sort of email to the client there, it's an absolute dream, because I can just write back and I can say, well, you may be saying X, Y, and Z about what the actuary did, but actually look at this contemporaneous note. It tells you it's the complete opposite and how you're going to dispute that. So having the record of the advice instructions is absolutely key when it comes to defending complaints and claims and hopefully avoiding them happening in the first instance. However, on the next slide, we've got a whole list of different sort of legal mechanisms that people use in order to try and avoid or mitigate complaints and claims. So first of all, it's something that Rich spoke to and Neil, the consulting services agreement, statements of work, the contract you have as a professional with your client. Now, there are two key things about that contract. First of all, who is it with? Who is the client? And as Neil mentioned, there can be situations where it's not clear who the client is, because actually your work's been produced and looked at by a whole series of different people. But naming who that client is and being clear who the client is absolutely key. And that's what the engagement terms, the statements of work, the consulting services agreement, retainer letter, whatever we call it, that should be very clear. Also needs to be very clear in terms of what the scope of the work is. Now, lawyers are not particularly good at having good engagement letters. I think probably the best profession that I see is accountants, because they do something that Neil mentioned. They not only say what they're doing, they say what they're not doing. So they say we're doing following X, Y, and Z, but it also means that the following fall outside of our retainer. So it's very clear what it is that they are engaged to do. And it's of course important that these retainer letters, contracts stand. You want them to be enforceable, because if they're not enforceable, because you're doing work for somebody who's not named in it, or you're doing work beyond the scope of your retainer, then you won't be able to rely upon all the terms and conditions and helpful things that you have in your contract. For example, limitations on liability, or if you're billing a client and you want paid within 30 days, you won't be able to rely on that sort of term if you're working outside the contract that you've agreed with your client. So that's absolutely key. In terms of enforceability of those agreements, before court, the key things that a court would look at in England and in the US and most common law jurisdictions is they look at whether or not it's signed. Hopefully the agreement will be signed, that's always helpful. Secondly, to the extent that the agreement's negotiated, there's a to and fro about what the terms are, what the scope is. The court will be able to see that there's informed consent there from the customer, that they have engaged, the client's engaged in what that contract says. And that's helpful in order to show that that agreement's enforceable. Also, it's always important to have your retainer, your statement of work, your consulting services agreement in place before you start substantive work. We get a lot of situations where 2 months in, the agreement's signed. That leaves a big question mark over what was the contract for those initial 2 months. You don't want to be in a situation where the error happens during that early period, because then there'll be a question mark as to whether your limit on liability operates or not. The other thing to be very careful about is what we call in the UK is retainer creep. You start very clearly with the client knowing what it is you've both engaged to do. You're very happy about that. But all of a sudden, a couple of months in, maybe even a year in, they ask you to do something else. And no one goes back and looks at that initial contract and thinks, actually, I'm starting to do something different to what I agreed to do at the outset. How am I going to get the protection of all those other things that I have in my engagement letter? So if your retainer changes, it's always important to go back and have a look at what you initially agreed to do. Another area is third-party releases, has already been mentioned by Richard and Neil. In the pensions world and the actuarial world, you're often producing work that others want to rely upon. However, if they're not a party to your engagement terms, they're not going to be a party to all of them helpful limits and liability that you have and all those other terms and conditions. So what you want to do is make sure that if other people are seeing your work and want to rely upon it, that you have an agreement in place that specifies that they will not hold you responsible for that. You can call it hold harmless, is one of the words that are used in England in relation to that. Or you can have them sign a release, or you can have them sign a document that excludes any liability for reliance on the work that you produced. Because what you don't want to do is have other people seeing the work, probably not paying for it, relying upon it, and you not having all of those helpful contractual limitations in place that you have with the customer, that you effectively undermine yourself by giving the document over to somebody else. Third-party releases do stand up in court, so it's important that you get that documentation in place. I'd also suggest that it also takes into account things like who the document is going to be seen by and confidentiality, because you don't want them passing it on again and again and again and ended up in a potentially even worse position. Another area of that it's helpful from a legal perspective to try and avoid or mitigate any complaints or claims is limits on liability. Now they can take a whole range of different forms. You can have a cap, you can have an amount of money that you're going to be responsible for, you can have a multiple of your fee that you're charging, you could link it to your insurance limits, you could do other things. You can change the limitation period. For example, in England, you have to bring a claim within 6 years of an error. You can change that. You can change it to 3 years if you want in order to try and limit your liability. You can exclude your liability for certain losses should you want to. Now, limitations on liability do stand up. They stand up in English courts and they stand up in the US as well. And there's quite a few cases in the accountants area in both jurisdictions in terms of the enforceability of limits on liability. These are the limits that exist in your retainer. So we're starting from the position that hopefully you're within your retainer and the person who's after you is the client in that retainer letter. But the things that a court looks at in terms of limits on liability is things like proportionality. If you have charged a huge fee and the loss is a £500,000 fee and the losses run into their millions, but you've got a cap of £10,000, chances are the court's not going to uphold that because your cap is so out of proportion to the losses and the fee. So having things tied to things like fee and insurance limits makes it much easier for courts to uphold your limit of liability. The court, just as with engagement terms, will look at negotiation between the parties. Have the parties negotiated this? Has the cap been highlighted? There is the cap on the front of the engagement letter in bold, as opposed to on page 42 of the terms and conditions, and it's really hard to find. They'll look at things like that and the bargaining position between the parties. If you are an actuarial firm acting for a customer, you're always just an individual who's not particularly high net worth, you'll have a lot more power, a lot more bargaining position. So the court will also take that into account. It's also fair that courts prefer limitations to exclusions. They're not very happy if you exclude liability, and certain things you cannot exclude, but they're much happier if you try and limit your liability in a proportionate way and in a way that the client seemingly gives informed consent to. So I would suggest that you always highlight your limits, you always think about the limit per piece of work that you conduct, the proportionality of it against the fee, against the type of work that you're doing. And if possible, you not only get the client to sign the engagement terms, but get them to sign specifically in relation to the limit and liability as well. That's quite helpful. Just go on to the next slide. So that's sort of the area, the legal mechanisms that you can use in order to limit your liability. What I've got on the next few slides is just some areas of risk as I see them for actuaries and in the pensions world in particular. I'm not going to spend a huge amount of time on this. It's probably just worth highlighting a couple of key areas where I see repeat errors or I often see complaints and claims. The first area is in relation to incorrect benefit statements, which is the top of that slide, and overpayments at the bottom. So effectively getting the numbers wrong and somebody relying upon you saying that either taking the money because it's an overpayment or saying, well, you gave me a benefit statement where my pension was X, but actually you're telling me it's Y. Now, in relation to that, and just going to the next slide, there are some key things to do around it. Sorry, Juan, if you can move to the next slide. Thank you. So one of the key things about overpayments and benefit statements, if they're wrong, then it's much easier if you sort them out quickly. Because the problem is if you overpay someone and they go off with the money, they can rely upon certain legal arguments such as estoppel for effectively preventing you from getting the money back, or saying that I've changed my position, you can't have the money back. And if you've got a benefit statement that's incorrect and it's putting the benefits too high, then again, you don't want people to be relying upon that. Instead, you want a situation where you correct it as soon as possible. So issues in relation to overpayments, incorrect benefit statements, they happen quite often. It's important to get ahead of the issues as early as possible. And as Neil mentioned, from an insurance perspective, make sure it's not a systemic problem, a problem that's recurred a number of times, i.e. a problem with a formula or something like that. If it is, then it's definitely something to speak to Rich and Neil about. Just two more quick points just to highlight on the next slide, which is in relation to the quasi-legal role. Now, one of the areas of risk that I see for those in the actuarial side is that they start to do a job that isn't that of the actuary. Now, from a UK perspective, that's often because what they're doing is interpreting legal documentation. They're interpreting the trust deed and rules, they're interpreting other legal instruments, legal documents. And as a result, they're starting to take on the role of a lawyer interpreting legal documents and outside the role of an actuary calculating numbers. Now, often the two go hand in hand, and it's sometimes quite difficult to differentiate the two. But as soon as you start doing the job of another professional, you are held to the standard of that other professional. And you won't necessarily get the benefit of all the engagement terms, terms and conditions, liability caps that I've talked about, because all of a sudden you're outside the scope of your retainer. So there's lots of issues in UK pensions in particular are on that slide, which are all seen as sort of legal issues. So from an actuarial point of view, it's important to stick to your role, stick to your job, and not to amend or get into the habit of looking at and interpreting legal documents, because all of a sudden you'd be held to a different standard. And the only other area of risk, which is on the next slide that I just wanted to highlight, which Rich has already been through, is data. And data is important to actuaries for two reasons. One, your benefit calculations are only as good as your data, so you want them to be good in the first place. And secondly, the amount of data that you hold. From an English law perspective, and it's the same across the European Union, we have the General Data Protection Regulations, which will apply to any entity that holds or controls personal data. And in the pensions area, you obviously hold an awful lot of personal data. Your social security numbers, national insurance numbers, how much people are paid, who they're going to leave their money to, all this very personal data. And that brings with it issues in relation to holding that data and making sure that you have the right policies in place, as Richard mentioned, which isn't not necessarily a professional indemnity, but your cyber policies as well, to react in the event of a problem in relation to your data. But separately, from a pensions perspective, the accuracy of your data is, of course, absolutely key for the purposes of ensuring that your numbers are right. And then finally, the other important thing from a professional indemnity policy, particularly from a UK perspective, which is on the next slide, is in relation to regulatory issues. So the actuarial world is coming under scrutiny, not only from what regulates the pensions area, which in the UK is the Pensions Regulator and the Financial Reporting Council, but also those entities that are responsible for the licensing of actuaries and responsible for making sure that they all follow the code of conduct. In England, that's the Institute, the Institute of Actuaries. They are getting a lot more active, less passive. They're upholding their rules in a much more aggressive way than they did previously. And your professional indemnity policy, as Neil mentioned, is often the gateway to help you get help if these types of issues come up. It's not just there to help you for complaints and claims. It's there as well, often, depending on the terms, for these regulatory and disciplinary issues that you may well need assistance for. So it's always important to look to your broker and your PI policy for those types of issues as well. Thank you very much for your time.
Okay, thank you, Rachel. So we do have some questions from the panel, from the attendees. First, how can professional organizations such as the American Academy of Actuaries in the US help define terms within the court system? For example, building economic scenarios for a client is not investment advice. That's just, I think, one example. But I guess more, how can the profession inform the courts as to what some of the terms of contracts or some of the terms of advice are. I'll start with you. Well, Rachel, go ahead. Yeah.
Yeah, I guess in terms of the court's approach to those sort of defined terms, in England, the court would look to an expert to help them try and understand those sort of issues to start with. So the court's not looking at them in a vacuum. It would ask an actuarial expert, an independent party, to come in and help them. In terms of how to assist in defining them, I think from a UK perspective as well, they would look at the professional organisations definitions and things like that to assist their own interpretation. So you would hope that the court wouldn't go off on sort of a frolic of its own. It would look at the what's actually within the profession, take the expert advice, look at things like what the professional organisation already provides for. So I think if you're doing things that the professional organisation already provides for, then you would hope that the court would follow that, not set a higher standard than say the regulator already provides.
Mm-hmm. Thank you. The next question relates to how important is the reference to region of jurisdiction. I guess these are moving, sorry. How important is the reference to region of jurisdiction or governing law when the SOW or the CSA refers to, for example, New York law or Delaware law, whereas the office for this particular consultant is located in another country, for example, somewhere in the Middle East, for example. You know,
Yeah.
how is that? Yeah.
Well, looking at the other questions that will fall mostly to Neil and Rich, I'll deal with this one. So if you've got so most contracts include a choice of law clause, so they'll pick the law that applies, and a lot of them also include a jurisdictional clause. They'll pick the jurisdiction in the court that applies, and they are generally upheld. And say in England, if someone had a choice of law of America, the jurisdiction of America, and somebody tried to issue proceedings in the UK, you could get what's called an anti-suit injunction. So you effectively prevent the proceedings happening in England because they should be happening in the court, in the jurisdiction, and applying the laws of the country in which the contract provides. So in that situation, if it refers to New York or Delaware, then there'll be the laws in the jurisdiction that would usually apply. And most jurisdictions would effectively, you could get an injunction in most jurisdictions to effectively prevent something going ahead in a jurisdiction that isn't provided for in the contract.
Mm-hmm. So just expanding on that question, how is obtaining PI cover best approached when work is carried out sometimes for the same client in several different territories or countries? Rich, Neil, Rachel?
Neil, you want to try that one?
I think it's important to sort of set out your contractual arrangements with your clients. I don't know if Rachel's got any further comments on that, but also engage with your broker in terms of the scope of your territorial and jurisdictional limits in your policy, and make sure that they cover the jurisdictions that where work is potentially being carried out. A lot of UK policies exclude the US and Canada because it's a more litigious environment, obviously. So it's just worth bearing that in mind if you're UK based, that you know, potentially claims might be excluded in the US and Canada. So you need to have both of those conversations, I would say, A, with your broker to make sure that any potential claims in those jurisdictions are covered, and B, if it's possible to look at the contractual position with your client in terms of, you know, where your agreement is set up. Is it governed by English law? And if there are specific conditions that you can put in your policy in relation to any disputes that you have. Did you have anything on that, Rachel?
No, I'd agree with that. I mean, the best you can do is make sure that your contract has the jurisdiction and choice of law that you want it to have. So when it sees proceedings elsewhere, then you have to fight them on the basis that that's the wrong forum to have the case heard. But as Neil mentioned, most PI policies I see as an English lawyer is they exclude the US and Canada. So if you are starting to do work with entities that are based in the US and Canada, then I would talk to your broker about expanding the terms of your insurance potential.
Yeah, and I'll address the US side. Basically, in the US, the policies are only for coverage in the US, Canada, or US territories. More because, and believe it or not, this is all due to government and their jurisdictions with regards to taxation. They all want a piece of the pie. And that's why it's limited to the US, is because these different states want to get their tax revenue from these insurance policies. And by the same token, the other countries do the same. They want their piece of the pie and their piece of the puzzle. For instance, in the US, we might have a lot of actuaries that also do work in the Bahamas and stuff. My recommendation is you get a policy for the US and you get a policy for the Bahamas from a broker in the Bahamas or a broker in the US to cover the different entity or the different countries you'll be working in. And the policies will be scripted to handle the jurisdictions and deal with those places. The main thing, though, as Rachel pointed out, is the contract needs to be clear that, you know, the work in that country stays in that country and is adjudicated in that country, et cetera, because that's where the policies are going to respond to. So in the US, we cannot issue a policy to any address except in a US location. So that's really the limitation on being able to put in policies that cover across around the world and so forth. If you're a very large actuarial firm, some of them do have place, or what would you call, locations around the world, and they could get a Lloyd's of London to cover in the different jurisdictions if there's enough premium. But what we're dealing with, the premium levels are such that the carriers aren't going to respond without a huge minimum premium that makes it, you know, basically not practical.
Yeah, I mean, you'd have to have locally admitted policies in a lot of jurisdictions, so separate policies, which, as you say, can be prohibitively expensive as well.
Okay, thank you. Any special tips if 3 independent and presumably unrelated consultants are teaming up to carry out a consulting project? Any special thoughts on obtaining professional indemnity insurance or developing the contract?
I mean, if I was in a situation I was asked to advise one of those 3 firms, I would say make it very clear who's responsible for which bit. You need to be very clear who is doing which part of it. I think separately you'd want to consider, and it'd be interesting to hear what Neil and Rich say about this, but whether or not you rely upon your own insurance policy as an independent contract consultant, or whether you get a standalone policy for that project might be something you look at, because of the messiness that you could end up with if there is a claim and then there's effectively notification to 3 different policies for each of the independent consultants. I can imagine that will be a bit messy, so I'd probably consider a standalone policy for that, if that's something that Neil and Rich think that they could place from the insurance perspective.
Yeah, I mean, I'd certainly say it's unusual in the UK for, you know, actuarial work. It's much more prevalent in the construction world, where you have, you know, single project policies, and Rich can probably speak quite well to that. But it's certainly something that should be explored if that's something you're doing regularly, and see whether that's possible or viable. But obviously, the other important thing is to make sure that the other 2 parties involved, or however many there are, have good insurance policies of their own, that you have similar limits and similar responsibilities. Because if you end up with a situation, which quite often happens with professional advisors, where you can be the last man or woman standing, everybody will come after your policy. You see quite a lot of cases, you know, involving financial advice, where you've got an independent financial advisor involved, you've got an actuary involved, and an accountant. The IFA goes bust, you know, and you're suddenly left with only a couple of people with insurance policies. So making it very clear that you've all got, you know, similar policies in place, I think, is a key part of that process, that you've all got policies that you can rely on. Yeah, I don't know if you've got any other views, Rich?
Well, I would just say that it's going to be driven by how you bill the client. If one of the 3 is the one doing the billing, then that's the one that's going to be holding the bag. So you would want all 3 to bill for their work separately, or they're all, you know, somebody's going to be holding the bag for the all. Now, it is possible for the policies, if you want to hire 2 independent contractors under your firm, the professional liability policy will expand over those other 2 clients and consider them part of your work if you're the one billing, if you're the actuary billing for the work. it will include coverage for the other two independents that join in on that particular job and cover them for your work, and their bit of work would be part of yours. So that would be the way to do it. If you did want to, if it's a smaller job and you're not going to want to buy a policy for 3 partners and that sort of thing, you could do it that way.
That's a really good idea. Obviously, only potential downside of that if the other 2 parties aren't quite as up to the job as you are, that you're effectively, underwriting their risk, aren't you? So
no question.
Just in mind.
Yeah, thank you. We're over, but let me just ask one further question. Questioner asks, are we liable if our system was hacked? And a second related question, are cyber risks relevant to PI?
I think you could take weeks to answer that question. It's a whole other subject. There's a strong connection between cyber and PI. And Rich was talking a bit about it earlier, that PI policies used to pick up some cyber risks. But certainly I can say from the UK perspective, there's a strong incentive to separate out cyber risk from PI, make it clear which policy responds to which. Cyber is predominantly there, I would say, to protect you in terms of, loss of clients' data, helping you recover clients' data, and having support on hand if you do have data breaches and that kind of thing. And your PI policy is there for third-party liabilities. But as I say, you could talk for weeks.
Right, and in the cyber world, the solution is really more or less a factor of how many files were lost, and the cyber policies will respond by typically some sort of negotiated settlement where they provide a LifeLock or some sort of monitoring service to those individuals that had their data, hacked for a period of a year, 2 years, whatever. And those are usually the solutions as far as through the courts or through the various government bodies that come up with those penalties. But yeah, typically nowadays the PI will have a sublimit for any cyber attacks if there's any coverage at all.
Okay, thank you all. This has been a very informative presentation. I appreciate all of you, or each of you, taking the time to speak with our attendees, and thanks very much.
Thank you.